Welcome to the Pacesetter Pod, where we explore and reveal the perspectives, insights, and approaches to deliver great results and growth in your agribusiness through better execution. Here's your host, the Integration Pacesetter, Joe Mosier.
Welcome, Pacesetters of Agribusiness, to another episode of the Pacesetter Pod, where we amplify voices from across the agricultural industry. We aggregate those perspectives and work to elevate our collective thinking around strategy execution. I'm your host, Joe Mosier, and I appreciate you tuning in today. Agribusiness is at a stage of maturity and continual evolution where it feels like every decision around strategy, positioning, tactics, they all feel like they carry this monumental pressure. And that pressure is born of the trade-offs that are required. Trade-offs around choosing what you're going to do and what you're not going to do. And there's not a leadership team, a board of directors, a CEO that I sit down with that doesn't at some point pretty early in the conversation signal the fact that there are these really tough trade-offs where there are either not obvious best options available, or the best option available has a really, really difficult, whether it's politically, financially, operationally, a difficult trade-off to manage. This shows up as things like choosing who we're going to serve and who we may no longer be best able to serve, choosing the business that we want to be in, and implicitly signaling perhaps what business we're no longer going to be investing in. Now, this is of course true in cooperatives. You know, the example being the constant tension between distributing financial returns today versus investing for tomorrow, while always delivering exceptional competitive services throughout the period. But co-ops don't have a monopoly on this challenge. It shows up in independent grain companies. You know, think about the marketing, risk management, physical handling, and infrastructure investments and options they have to choose from. It shows up in independent seed companies that we've worked with and the kind of go-to-market strategies that they're looking at, whether that's direct to farm and retail versus channel partners and distributor approaches. And even in smaller ag retail businesses and co-ops, but ag retail that face questions like, do we want to be a cash and carry business or a full service operation, or are we trying to be effective at both to serve our trade area? And this has been, frankly, it's been in my head for a while, and I've wanted to talk about it and trying to figure out what's the best structure to put around this discussion. But it's been especially acute the past few weeks after an interview I did with a guest who made the very astute observation. I'm not challenging the observation at all, but he had said that ag retail operations, whether they're independent or within a co-op, the mandate's pretty simple. You have to dominate the 50-mile radius around your location. And implicit in that strategy of dominate that 50-mile radius is the idea that you don't get to choose between being cash and carry or full service. That you have to find a way to meet the diverse set of farmer needs and whatever it is that they might be requiring and demanding of you. There's a lot of truth to that statement. I don't dispute the felt reality of it, but it's also kind of unsettling from a strategic perspective. You know, I don't want to pretend and sit here that and act like business is as easy as making a strict binary choice. You know, we're going to do A or we're going to do B, or we're not going to do both, right? It's rarely that simple. But the notion that you don't have a choice, but to meet the needs of everybody, that can be pretty problematic if you don't actually break it down and consider why it may be true for your business, why it might be less true than you thought, and ultimately what that decision is going to cost you or reward you in terms of focus and opportunity and results. All this to say, I think we should use this as a live test case to highlight the concept of not just strategy, but strategy tax and how it shows up in agribusiness. Today, we're going to talk about what strategy is. We'll talk about the concept of strategy tax. We're going to run through the familiar scenario of that strategic tension around cash and carry versus full service. And we'll do a special carve out and highlight why this is especially challenging for agricultural cooperatives. And I'm going to share 5 questions that I think you can ask you and your leadership team, and they can help anchor you to the underlying themes, the thematic objectives you're trying to accomplish when you're making these tough strategic decisions that are going to levy a strategy tax on your organization. And the idea isn't how to eliminate it, but how to optimize the decision to kind of minimize that downside. Thank you as always for tuning in today. Before we start, a quick reminder to like and subscribe to the podcast wherever you get your podcasts. You can do it right now on your platform of choice. Please consider leaving us a review and letting us know how we're doing. It's free. It doesn't cost a thing. It only takes a moment, and it's the best way to support the program and ensure that we get this content out to as many people as can benefit from it. Okay, so let's get started. And I don't want to spend a lot of time here, but what is strategy? Right, I know we talked about this a lot in the program. If you're a regular listener, you can probably kind of tune out for the next 2 minutes here or so. But I think what's really important in the context of this conversation is, we need to make sure we don't confuse strategy with goals and tactics. And so I really want to dig into that. Strategy is deciding where you want to go and choosing the best path to get there, considering all the resources and obstacles that are in your way. In everyday terms, it's not just having a goal, and it's not just taking action. It's the thinking in between, figuring out how you're going to win before you start playing the game. A simple way to think about this is if someone asks, what are you going to do? Right? What are you going to do in the next quarter? Those are tactics. If they ask, why that and not something else? That's strategy. Right? It's the explicit decisions around what game we're going to play and how we're going to win. Strategy isn't just, we want to grow revenue 10%. That's a goal. Strategy is a set of choices about where you will and won't compete and who you will and won't serve. And also core to strong strategy is the concept of competitive advantages. We're not going to talk about this at length. We could probably do a show about it. But I think a competitive advantage is really important to think about here and throughout the rest of this discussion today. A competitive advantage is simply whatever makes customers choose you over your competitors. And not just choose you at that time, but to continue to choose you and come back over time. Competitive advantages are the durable advantages that will help you win over the long term and the things that are less susceptible to competitive pressure in your marketplace. Now, as we talk about strategy and competitive advantages, the other concept that I want to kind of refresh us on is the idea of strategy tax. Every strategic choice that you make comes with a cost. There's things that you give up, customers that you're going to disappoint, capabilities that you're not going to be able to build. That cost is the tax. And avoiding the tax by trying to do everything, which is kind of what inspired this discussion today and is a very common tactic. We don't want to pay that tax. We're not going to make those hard choices. We're going to kind of be everything to everybody. That's fine, but you usually end up doing none of those things particularly well, which means you've lowered the acute tax to one particular part of the business, but you've kind of spread it across the entirety of the organization. And the aggregate, net value of that tax or negative value of that tax might be greater than if you had made those tough choices. Not always, but it's something to think about. Now, the concept of strategy tax is not entirely dissimilar to opportunity costs, which focus you on the things that you forfeit the chance to do because you're doing something else. But I think when you cast this as a strategy tax, it's a more reflective of the real financial impact a set of decisions has. The idea is not necessarily to limit strategy tax. I'd be happy to be debated on that point, but rather to have visibility and awareness to the taxes that you're paying so that you can properly discount the net value of operationalizing your strategy and saying, look, we're making this strategy to create this value for our organization and push us in this direction. And we understand that it's going to be discounted against certain offsetting downsides that we have recognized and accepted as part of getting this done. Now, if you want to hear more about this concept directly, strategy tax specifically, you can go in the way back machine to episode 33, where I sat down with Shane Thomas of Upstream Ag to dig into this concept. Not all platforms will show you the entire back catalog, but Apple Podcasts does, and I'll be sure to include a link to that episode in the show notes. To kind of land the point here, co-ops, independent local agribusinesses, anyone along this ag value chain are especially susceptible to that strategic drift because member ownership or that intimate nature of hyper-local rural community relationships, they all cause us to have this instinct to want to serve all members or support all customers. And while that is noble and rational to a certain degree, it does become the enemy of serving any one particular segment especially well. So let's dig into a case study in this strategic tension, this thing that really kind of highlights the importance of strategy tax. And that's cash and carry versus full service. I think it's an incredibly useful, concrete illustration of what these trade-offs look like. And it's something that I hope resonates with most of you. If not, there's probably other examples within your business that you can think of as we go here. So before we get too far into this, let's just describe the two archetypes we're talking about here. In a cash and carry business, the farmer knows exactly what he wants. He shows up with a trailer, he loads the product, he writes a check, and he leaves. Right? That's the cash and carry model. A full service model, conversely, the farmer wants agronomic advice. He wants custom application. He may require credit and credit terms. Probably is looking for some soil sampling and is ultimately looking for a trusted relationship with a rep in your organization that knows his operation. These two customers are not just different in what they buy, they're really different in fundamentally what they value. And building an operation within your company to delight one profile really risks, disappointing the other one. To some degree, it might be unavoidable. Now, that's kind of the high-level summary of what they are, but let's think about what's the pros and cons of these. And this is not going to be a complete diagnostic, so forgive me in advance, but hopefully it hits the major high notes. In a cash and carry model, you're going to have, lower relative overhead. You're certainly going to have faster inventory turns. In many cases, you have better margin on product sales. And while it's not a simple operation, it's simple relative to a full service operation, right? You're warehousing and retailing product. You're unloading it from your distributors, you're loading it to your customers, you're collecting the money and moving on. It scales well. This is a business that scales well if you have the capital and the inventory turns, and it's less dependent on really deep staff expertise. The downside is, there's a very real risk that you're going to commoditize yourself over time. Because in a cash and carry environment, price becomes the primary, if not the only differentiator. And someone, maybe not Amazon in the agribusiness example, but an FBN or other folks, a bigger regional player, a larger ag retailer, they can almost always beat you on price eventually. And ironically, that initial product margin advantage that you may have had that made cash and carry attractive is the first thing that's going to be competed away over time. So, this is not to dissuade people from cash and carry. It's just my observation around what some of the long-term economics of that model actually are, particularly as you get more in different distribution channels that are reaching out and going directly to the farmer. I think the net impact also is that the customer relationship becomes shallower on a relative basis, not shallow in absolute terms, but on a relative basis, because the switching costs for that farmer over time become near zero. Right? There's not a lot that prevents them from being able to buy product, neither go pick it up or have it delivered from somebody else, if buying the product is the entirety of the relationship that they have around this particular part of their business. Now, the merits and maybe the downsides of full service, some of the merits, of course, are, you kind of form these very deep, intimate relationships. And from that come some pretty high switching costs, which creates customer stickiness and a higher degree of retention. And also if you are disciplined enough and courageous enough to demand it, there's an ability to charge for the expertise that you're providing and the convenience of services. It tends to create genuine loyalty over time. And there's a lot of studies that show that the share of wallet of that producer transacting with your company will also increase over time because of that deep, intimate relationship. The downside, of course, is that it's expensive to deliver. You need agronomists, which we all know are becoming harder and harder to find and to develop and to retain. You need that credit infrastructure in place. You need, of course, the fleet and the application equipment and the maintenance therein. You need a lot of coordination. You become a logistics and fleet dispatch organization very quickly. And, the margin can get squeezed if you're providing full service model at cash and carry product prices, which happens particularly when organizations haven't fully committed to the model. And historically, I don't know if we as an industry have done the best job of always articulating the aggregate value provided by, that whole suite of services, the soil sampling, the agronomic advice, the retailing diverse products, providing application services, supporting the reverse logistics of returns and refunds and reapplications, et cetera. If you haven't properly communicated the value of each leg of that full service model and priced it accordingly, the margins can compress very quickly and in ways that are hard to isolate and solve for. So that's kind of breaking down both. Now, the real challenge, the way we're talking about this, is kind of let's call it the messy middle here. This is where many operations live. They're trying to do both without full commitment to either, because growers, whether it's membership or growers just in your trade area, if you're a privately held agribusiness, they tend to want different things. And what happens over time, again, being somewhat general here, but the full service farmer's frustrated because the infrastructure isn't quite there to meet the needs that he or she has across that entire spectrum of services. The cash and carry farmer is annoyed because they're perhaps paying elevated costs that are covering the overhead costs baked into the price for services that he doesn't receive or value. And what tends to happen, because you have this bifurcation of attention and focus in the way you're operating, neither segment's particularly delighted. And if they're not delighted, you'll either see limited growth potential or even potentially erosion through customer attrition, customer loss, losing share of wallet over time. And that's the strategy tax showing up in your P&L. That's the strategy tax showing up in your customer satisfaction. That's the strategy tax sitting on the shoulders of the growth of your agribusiness.
Poorly executed mergers and acquisitions destroy more value than they create. They can set your company back years. To defend your firm's position in the marketplace, you need access to the leading practices that unlock the greater potential of your people, processes, and systems. If you are undertaking a company transformation or pursuing an acquisition as a vehicle to grow, set up a call with Joe by visiting www.moshercg.com.
Now, I want to do a brief carve out here and speak specifically to our cooperative listeners, because I think this is an especially challenging, a vexing challenge for your business models. Now, I recognize it's far too easy for me to sit here and just pontificate comfortably into a microphone in my office. And we need to acknowledge that there's a structural reality that you all live, operate, and compete in. Member pressure that you all carry is real. When a member owner walks in and says, "I need X," it's genuinely hard to say, "I hear you, I understand, but I apologize, that's not what we do." That's a much harder message to deliver than it is for an investor-owned competitor, a privately owned competitor that is able to make those decisions. And you'll hear about it in the market, but you won't necessarily hear about it at your annual meeting, right? So this is a structural challenge that you all have as cooperatives. Also, in the cooperative context, board dynamics can kind of reinforce the drift, not because of poor performance or poor training or poor execution by the boards, not at all. But boards often represent diverse constituencies. They're elected by their membership to represent their membership and to advocate for their membership. Whether that's in approving capital deployment, hiring and firing the GM, ensuring that we're doing the right things to protect and increase member equity. And that, because they represent such diverse constituencies, it makes it hard to prioritize one type of member over another. History and momentum matter in co-ops. And many co-ops, in my observation and my telling of the marketplace, have inherited their current model, whether it's cash and carry or full service or some blend thereof. They've inherited it more than they've designed it, which means that strategic inertia of continuing to do what we've done is kind of the default setting. So if you think about the fact that it's harder to say no to your member who walks in the door saying, "I want you to do something," and the board is advocating for multiple different perspectives, and you've got this inertia machine running in the background because this is how we've always done it, this makes it a very difficult challenge. And I don't want to skip past that or fail to recognize that. The democratic governance structure of co-ops is one of the greatest strengths of the system. One member, one vote. We're here for the shared prosperity of our grower base, and we're going to execute on service and price and market access. But it's also one of the biggest obstacles to strategic clarity. And that might be uncomfortable to say or to hear, but it doesn't make it untrue. That tension deserves honest conversation at the board levels and at the management levels, and we have to wrestle with that. So I digress, but I wanted to make sure that it wasn't seen as flippant or being too cavalier with that and skipping past the very real challenges that you and the cooperative system face. Now, naming this overall problem, back to sort of the tension between cash and carry and full service operations, naming the problem might be interesting, but on its own, that's not all that helpful, right? I've probably told you guys largely in the last 20 minutes what you already know. So I want to share something that's actionable with you, a series of questions that you can take back to your leadership team that might help you actually move the ball here. Now, before we get into the 5 questions, something you need to know is that this is a diagnostic exercise. It's not a prescription. I would never presume to sit here or in one of your board meetings and state declaratively, this is right and this is wrong. I'm certainly going to have an opinion like everybody else, but whether it is your executive team, your board of directors, or some mix thereof, and whether you're sitting in a conference room or at a bar after the meeting, in my perspective, it is the asking of the right questions that force the right, honest conversations that are of the most value. So let's run through them. First question is asking yourself and your leadership team, who are our most profitable customers and what do they actually need, right? You run the analysis of your most profitable customers. You do the work to strip out those accounts that consume the most service time and resources because you need to look at the net margin by customer. And this is going to be a little bit art and science, but you guys all know that the top line revenue number, even the bottom line margin number on the financial statement for a given customer, that's not fully reflective of the net value, the net margin back to the business. They have different levels of demands. Some are easier to work with, some are more difficult. So if you can find a way to strip those accounts out that require the most service time, the most maintenance and management, you can actually look at net margin by customer. When you get there, the answers may surprise you, right? Where does profitability among your customer base actually reside? Keep in mind, though, this is just one question, and the answers that you get to this question are not sufficient to act, but it's a baseline set of facts that you need to operate from. So if question number 1 is, what's your most profitable customers and what do they actually need? Question 2 is, what does your geography and your competitive landscape actually allow? So in some markets, the full service co-op is the only player, right? That's a strategic asset to that marketplace. In others, there's 3 competitors who already do it well from a full line service perspective. And you might look at this and say, well, cash and carry is actually the underserved niche opportunity. Whatever that falls out as, the idea is here to know your terrain. And when you pair this, what does the geography and competitive landscape allow? When you pair this with that close examination of the profitability of customers in the first question, you're beginning to frame up a more comprehensive view of the attractive options available to the degree that they are. So second question, what does your geography and competitive landscape allow? The third question is, what capabilities do you actually have and can you realistically build? You got to be honest with yourselves here. This is very similar to the M&A discussions we have, where we try to work with our clients to say, are you clear-eyed and have a full appreciation for the demands of integration? Because this deal might pencil on paper, but if you can't execute and bring these companies together, there's going to be a lot of customer loss, a lot of employee turnover, and probably a lot of value destruction before you get to those positive benefits that you sort of penciled out in your pro forma. Full service operations require talent. You need agronomists, again, a very coveted resource, and that compounds year over year. You need trusted reps. You need professional credit management staff. You need to have access to the best drivers and the folks and, tender truck drivers, application equipment, all of that. And if that talent pipeline isn't there, and if you don't see a path to building it, committing to full service is a strategy on paper that's going to fall apart in execution. And you should be honest with yourselves. Now, I've been saying in this program for more than 3 years now that one of the most common torpedoes wrecking strategy execution is leadership teams not reconciling the business that they want with the business that they have. And so again, whether it's, looking at strategy tax, whether it's looking at M&A, get clear-eyed about where the gaps are. Whether those gaps are people, product, process, technology, capital, whatever it is, you will never say, okay, we have too much clarity in this organization to win. Asking this question, what capabilities do you actually have and can you realistically build? Asking this question is a critical look in the mirror, and it's a very important de-risking exercise because it helps you see the world in your company as it is, not as you wish it to be, and then you can build from there. Question 4, and this is incredibly important, particularly for co-ops. We're going to talk about members here, but it could be customers as well. But what do your members value most? And are those the members you want to optimize for in the next decade? So in the first question, we talked about your most profitable customers, net of the cost of serving them. Now you're looking at the membership overall and saying, what do they value most? And who do we want to optimize for over the next decade? This is probably the hardest question because it requires leadership to say our future may look different than our past. And some current members may be better served by a competitor. And again, that's incredibly difficult to say out loud, but that's a legitimate strategic outcome. We don't have time to spend on this today in any sort of next level detail, but I don't want you to mistake me as skipping past this quickly or failing to understand how thorny the issue is. But if you missed the discussion around member segmentation and sort of thinking future focused on this, you can go back and check out episode 153 where we talked about member segmentation, member fragmentation. And that episode will dig in and speak directly to co-ops and the concepts and processes that will lift and shift and apply easily within your co-op as well as within non-owner customers or privately held agribusinesses as well. So question number 4, what do your members value most, and are those the members you want to optimize for? And the fifth and final question is, what are you willing to stop doing or do less of? Right? That all comes down to now that you've done this tabletop exercise, you've looked at some data, you've had some discussions of leadership, you've looked into the future. Now it's about intestinal fortitude and appetite for pain and tolerance for change. Right? This is back to where we started. Strategy, we often talk about doing something more, doing something new, doing something different as we talk about where do we want to play and where do we want to win. But strategy can also be addition through subtraction. And you can accomplish a lot by just being more focused on fewer things. If you decide to go full service, you may need to stop competing on cash and carry pricing entirely, right? If it's just too hard to have different pricing models for the same product and it's creating too much confusion among your customer and membership base, if it's creating too much duplicative processes for your employees, it's creating errors, that just might be the outcomes. That say, look, we're going to price everything in the full service, and we understand and expect and regrettably are going to be losing a lot of cash and carry pricing customers. And conversely, if you go cash and carry, and that's where you're all in, that sort of suggests you're going to need to wind down your agronomy staff. And just ask yourself, can you make that call? Faced with that, do you have the conviction that cash and carry is our long-term strategy? And we're going to, rather than pay this strategy tax by having our staff and our suppliers and our customers and dispatchers and drivers, everyone being kind of confused about what's going on, we're going all in and we're going to take that decision as painful as it is. Land the plane here. The goal isn't to answer these questions perfectly, not today, not even in the first time you ask them, but it's to have the right conversation rather than avoiding them. So very quickly, I'm going to run through the 5 questions again. Number 1, who are your most profitable customers and what do they actually need? Number 2, what does your geography and competitive landscape allow? Number 3, what capabilities do you actually have or can you realistically seeing a path to build? 4, what do your members value most and are those the members that you want to optimize for over the next decade? And number 5, as a result of all that, what are you willing to stop doing? What are you willing to do less of? So I want to summarize what I hope you walk away with today, a couple key takeaways. The best run co-ops or independent ag retailers or agribusinesses writ large, the best ones that you'll encounter aren't necessarily the ones with the best resources or the best market or the best branding. They're often the ones that made clear decisions about what they were going to do and not do, and then built everything around executing those decisions well. They're organizations that understood that avoiding the strategic conversation, avoiding the idea of strategy tax doesn't make the trade-offs go away, right? Not having those discussions doesn't make it go away. It just means the market's going to make the choice for you. And usually at a worse time and under worse conditions than you might like. You may decide to be everything to everyone. You may decide to be that ag retailer that dominates that 50-mile radius around your location. And that is acceptable if and only if it's a conscious and explicit choice that you have made and that you understand what the ancillary or adjacent challenges are that you are going to adopt, that you're agreeing to work through. There's going to be pain here, no matter what choice you make. There's also likely to be upside, depending on the analysis you've done. But both your customers and your member owners, they depend on you, and they deserve a commercial partner, a supplier of products and services that makes strategic decisions, not someone who takes inertia-driven default positions. And here's a challenge to each of you that are listening. Before your next board meeting, before your next leadership team retreat, ask your team this: who are we actually for? And is everything that we're doing aligned with that answer? Now, that's going to boil over into a pretty big discussion pretty fast. But unless everybody gives you the exact same answer, that's clear signal that you need to spend some time there. And the good news is you don't have to pay anything to ask that question. It's just your time. Avoiding that question because you might not like the answer, frankly, I think is irresponsible. And everyone should be able to look at that and say, yes, we know who we're for, and we have conviction that everything we're doing is aligned with that answer, or we're putting things in place to move towards making that true. If the answer that you get back is murky, that's not a failure, that's a starting point, okay? The work of strategy is clarifying that answer over time. And as you clarify that answer over time, having the courage to act on it. And if you do that right, the strategy taxes that you end up paying ought to be worth it. I hope that was helpful today. Thank you as always for tuning in. I appreciate you being part of the Pacesetter Pod community and taking the time to listen in, to consider some different perspectives that myself and my guests share each week, and hopefully actioning ways to improve strategy execution, all in support of growing your agribusiness. We'd love to hear how we're doing. Feel free to reach out. You got my contact information in the show notes. Listener feedback is the best way for us to improve the level of the content and insight and perspectives that we offer, and also make sure that we're talking about things that are relevant and helpful to you. So let us know. This is a group project. Thanks again for joining the Pacesetter Pod today. I look forward to having you join us next time.
This is thepodcastfactory.com.